Welcome to NFT Wealth Blueprint, Building Digital Assets That Last. Your guide to understanding, navigating, and succeeding in the rapidly evolving world of digital ownership. Brought to you by Finance & Son, where knowledge meets opportunity, this audiobook is designed to give you clear, practical insights into one of the most transformative shifts in modern finance. NFTs, non-fungible tokens, have captured global attention. Some see opportunity, others see uncertainty, and many are left wondering what's real and what's just hype. In this audiobook, we move beyond speculation and focus on what truly matters, building sustainable digital wealth. Whether you are a beginner exploring NFTs for the first time or a professional looking to sharpen your investment strategy, this blueprint will guide you step by step. You'll learn what NFTs actually are and why they matter, how to evaluate projects with confidence, strategies to manage risk in a volatile market, and how to build a portfolio designed for long-term value. This is not about chasing trends. This is about understanding systems. This is about making informed decisions. And most importantly, this is about positioning yourself for the future of digital assets. The world of finance is evolving. Ownership is becoming digital. And those who understand it early gain the advantage. What are NFTs? No-Jargon explanation. To understand NFTs, we need to start with a simple idea: ownership. In the physical world, ownership is easy to recognize. If you buy a house, you have a title. If you buy a car, you have keys and documents. If you purchase a piece of art, you can hold it, display it, and prove it belongs to you. But what happens when everything moves online? Think about the digital world you interact with every day. You can download images, you can stream music, you can share videos instantly. But here's the problem: you don't actually own most of it. When you save a photo or buy digital content, you're often just getting access, not true ownership. Anyone can copy it, anyone can share it, and in many cases, you don't control it. This is where NFTs come in. NFT stands for non-fungible token. Now let's simplify that. Non-fungible simply means unique. It cannot be replaced with something identical. For example, a 10-pound note is interchangeable with another 10-pound note. But a one-of-a-kind painting is not. That painting is unique, and that's what NFTs represent in the digital world. An NFT is a digital proof of ownership. It tells the world, this specific digital item belongs to you. Imagine buying a piece of digital art. Without NFTs, anyone could copy that image, and they still can. But with an NFT, there is a verified record showing that you are the official owner. It's like having a signed certificate, but stored securely online. So, NFTs are not the image itself. They are the proof that you own the original. This proof is stored on something called a blockchain. You don't need to think of it as something complicated. Just imagine a public digital record book that cannot be altered, cannot be faked, and is visible to anyone. Once ownership is recorded there, it becomes permanent and secure. This changes everything. For the first time, digital items can be owned, bought, sold, and transferred, just like physical assets. And it doesn't stop at art. NFTs can represent music, in-game items, collectibles, memberships, even real-world assets. In simple terms, NFTs turn the internet into a place where ownership matters. Before NFTs, digital content was easy to access, but difficult to truly own. After NFTs, ownership becomes clear, verifiable, and transferable. This is the foundation of digital ownership, and it's only the beginning. In the next section, we'll explore how this idea evolved, and why NFTs are part of a much bigger shift known as Web 3. Blockchain fundamentals simplified. To truly understand NFTs, you need to understand the system that makes them possible. That system is called blockchain. Now, don't let the word intimidate you. At its core, blockchain is simple. Imagine a notebook. Not just any notebook, but one that is shared with thousands of people, updated in real time, and impossible to secretly change. Every time something happens, like a transaction, it gets written into this notebook. Once it's written, it cannot be erased or altered. That's blockchain. What does blockchain actually mean? The word itself gives you a clue. It's made up of two parts: block, chain. A block is a group of information. For example, who owns something, when it was bought, how it was transferred. Once that block is full, it gets linked or chained to the previous block, and then another block is added, and another. Over time, you get a chain of records, a complete history that anyone can verify. Why blockchain matters. In traditional systems, records are controlled by a central authority. For example, banks control financial records, companies control user data, platforms control digital assets. This creates a problem. You have to trust that these systems are accurate and fair. Blockchain removes that dependency. Instead of one central authority, the record is shared across many computers, verified by a network, and secured through technology. This means no single person or company can manipulate it. Think of it like this. Imagine buying a rare digital item. Instead of relying on a company to confirm your ownership, the blockchain records it publicly. Anyone can check it, no one can change it, and you remain the verified owner. How this connects to NFTs. NFTs rely on blockchain to function. When you buy an NFT, the transaction is recorded on the blockchain. Your ownership is stored there, and it becomes part of a permanent history. This is what gives NFTs their power. Without blockchain, NFTs wouldn't be secure, they wouldn't be verifiable, and they wouldn't have real value. The bigger picture. Blockchain is not just about NFTs. It represents a shift in how we handle ownership, trust, and value. Instead of relying on institutions, we rely on transparent systems. For the first time, people can own digital assets directly, transfer them without intermediaries, and verify everything independently. This is the foundation of digital ownership. And once you understand this, NFTs stop being confusing and start making sense. In the next section, we'll explore why this shift is happening now and how NFTs evolved into a global market. Why ownership is changing in the digital age. Ownership has always been a fundamental part of how we live, work, and build wealth. For centuries, it was simple. If you could hold it, you could own it. If you could prove it, you could protect it. And if you owned it, you could transfer its value. But the world has changed. Today, more of our lives exist in digital spaces than ever before. We work online, we socialize online, we create, share, and consume content online. Yet despite this shift, ownership has not kept up. The problem with digital ownership. Think about the platforms you use every day. Social media, streaming services, online marketplaces. You can spend years building content, followers, digital assets. But in reality, you don't truly own them. Your account can be restricted. Your content can be removed. Your access can be taken away. Because in most cases, the platform owns everything. Items selling their security. This is the key shift. In the traditional digital world, you are given access, not ownership. When you buy a movie online, you don't own it. You're licensed to watch it. When you purchase in-game items, you don't control them. The game does. When you upload content, you don't fully own distribution. The platform decides. Access is convenient, but it comes with limitations. The turning point. As the digital world expanded, people began to question this model. Why spend time creating value if you don't truly own it? Why invest in digital assets if they can disappear overnight? Why rely on systems where control is centralized? These questions sparked a shift. A new ownership model. This is where blockchain technology and NFTs enter the picture. For the first time, digital ownership becomes independent, verifiable, and transferable without permission. You don't need a platform to confirm what you own. The system itself does it. This changes the relationship between users and the digital world. Instead of being users, you become owners. Why this matters? Ownership creates value. When you truly own something, you can sell it, trade it, hold it long-term, or build on top of it. This is how wealth has always been created, and now that same principle is entering the digital space. The bigger shift. We are moving from a world of platforms controlling assets to a world of individuals owning assets. This is more than technology. It's a shift in power. Creators gain control over their work. Investors gain control over their assets. Users gain control over their digital identity. Ownership is no longer tied to physical objects. It's becoming digital, global, and borderless. Those who understand this shift early position themselves differently, because this isn't just about NFTs. It's about the future of finance, creativity, and ownership itself. The question is no longer if ownership will change. It's already happening. The real question is, will you understand it or be left behind by it? NFTs versus traditional assets. To fully understand the value of NFTs, it helps to compare them to something familiar: traditional assets. What are traditional assets? Traditional assets are things people have used for generations to store and grow wealth. For example, real estate, stocks, gold, physical art. These assets share a few key characteristics. They are owned, recognized, and transferable. If you own a house, your ownership is recorded. If you own shares, they are tracked in financial systems. If you own gold, you can store or sell it. These systems work, but they also come with limitations. NFTs, limitations of traditional assets. Traditional ownership often depends on intermediaries like banks or brokers, legal systems for verification, geographic boundaries. Transactions can be slow, costly, and sometimes restricted. For example, selling property can take months, transferring assets across borders can be complex, and access is not always equal for everyone. Enter NFTs. NFTs bring these same principles of ownership into the digital world, but with a different structure. Like traditional assets, NFTs can be owned, bought, and sold, held for value. But unlike traditional assets, NFTs are digital, borderless, and powered by blockchain technology. Key differences. 1. Physical versus digital. Traditional assets exist in the physical world. NFTs exist entirely online. This means NFTs can be transferred instantly, without physical limitations. 2. Speed and accessibility. Traditional transactions often require paperwork, approval processes, third parties. NFT transactions can happen in minutes, directly between individuals, without intermediaries. 3. Global reach. Traditional assets are often tied to specific countries or systems. NFTs operate on global networks. Anyone with internet access can participate. 4. Transparency. With traditional assets, records are often private or controlled. With NFTs, ownership is public, verifiable, and secure on the blockchain. What they have in common, despite their differences, NFTs and traditional assets share something important. Value comes from perception and demand. A house has value because people need it. Gold has value because people trust it. Art has value because people appreciate it. And NFTs, they have value when people believe in their utility, communities support them, and markets demand them. eBay, a new asset class. NFTs are not here to replace traditional assets. They are creating a new category. A category where ownership is digital, transactions are efficient, and access is global. This opens the door to new opportunities, but also new risks. Just like any asset class, understanding is key. Traditional assets built the foundation of wealth in the physical world. NFTs are extending that foundation into the digital world. Different structure, same core principle. Ownership creates value. From Bitcoin, Ethereum, NFTs. To understand where NFTs are going, you first need to understand where they came from. NFTs didn't appear overnight. They are the result of a technological evolution, one that began with a single idea. What if money could exist without banks? The beginning, Bitcoin. In 2009, Bitcoin was introduced. For the first time, people could send money directly to each other, without a bank, without an intermediary. Bitcoin created a system where transactions were transparent, secure, and decentralized. But Bitcoin had a limitation. It was designed mainly for one purpose: digital money. It could store and transfer value, but it couldn't do much beyond that. The next step, Ethereum. Then came Ethereum. Ethereum expanded the idea of blockchain. Instead of just handling money, it allowed developers to build applications on top of it. These applications are powered by something called smart contracts. Now, don't let the term confuse you. A smart contract is simply a set of rules that automatically executes when conditions are met. No middleman, no manual process, just code doing exactly what it's programmed to do. This changed everything, because now blockchain could do more than transfer money. It could create systems, power platforms, and manage ownership. The birth of NFTs. With Ethereum in place, NFTs became possible. For the first time, developers could create unique digital assets on the blockchain. Not just currency, but individuality. Each NFT could represent a piece of art, a collectible, a digital item, or access to something valuable. This solved a major problem of the internet: digital uniqueness. Before NFTs, everything online could be copied endlessly. After NFTs, ownership became distinct, verifiable, and secure. Enter Web3. As this technology evolved, a new concept emerged: Web3. To understand Web3, Think of the internet in stages. Web 1, the read-only internet. You could consume information, but not interact much. Web 2, the interactive internet. You could create content, connect, and share. But platforms controlled everything. Web 3, the ownership internet. You can now own your digital assets, control your identity, participate in decentralized systems. NFTs are a core part of this new phase. They represent ownership in a world that was once built only for access. Why this evolution matters. Each step built on the last. Bitcoin introduced trustless money. Ethereum introduced programmable systems. NFTs introduced digital ownership. Together, they form the foundation of a new digital economy, one where value moves freely, ownership is transparent, and control shifts back to individuals. NFTs are not a trend. They are the result of years of innovation, from money to systems to ownership. This is the evolution, and we are still in the early stages. The rise of digital scarcity. In the physical world, scarcity has always been simple. A rare painting is valuable because only one exists. Gold holds value because it is limited. Collectibles become desirable because not everyone can have them. Scarcity creates value. But in the digital world, scarcity didn't exist. The problem: infinite copying. For decades, the internet was built on one powerful feature: replication. You could copy anything: images, music, videos, and once something was online, it could be duplicated endlessly, instantly, perfectly, for free. This created a major limitation. If everything can be copied, nothing is truly rare. And if nothing is rare, it becomes difficult to assign real value. Access over ownership. This is why the digital economy focused on access instead of ownership. Platforms made money by controlling distribution, visibility, and attention, not by enabling true ownership. You could experience content, but you couldn't own it in a meaningful way. That was the old model. The breakthrough: digital scarcity. Blockchain technology changed this. For the first time, it became possible to create something digital that is unique, limited, and verifiably scarce. This is what we call digital scarcity. NFTs made this concept real. Each NFT can be one of a kind, part of a limited collection, or programmed with a fixed supply. And most importantly, this scarcity is provable on the blockchain. Why this changes everything. Digital scarcity introduces something the internet never had before: true ownership with limits. Now, instead of infinite copies, there can be one original, 100 limited editions, or 10,000 unique items, just like physical collectibles. And when something is limited, it can become valuable. Real-world comparison. Think of digital scarcity like owning a signed limited edition print. Anyone can view the image, but only a few can own the authentic version. NFTs bring that same concept online. The impact on value. When scarcity is introduced, markets begin to form. People start to collect, trade, and invest, not because something exists, but because it is limited and owned. This is why certain NFTs gain attention, not just because they are digital, but because they are scarce, verified, and desired. A new digital economy. Digital scarcity is the foundation of a new type of economy, one where creators can limit supply, buyers can prove ownership, and markets can assign value, without relying on central platforms. This transforms digital content from something that is freely copied into something that can be owned, valued, and traded. Now, for the first time, it exists in the digital world too. And scarcity has always driven value in the physical world. Now, for the first time, it exists in the digital world too. Key milestones in NFT history. To understand where NFTs are today, we need to look at the moments that shaped their journey, because what may seem like a sudden trend is actually the result of years of innovation, experimentation, and growth. The early foundations, 2012 to 2016. Before NFTs became mainstream, the idea of digital ownership was already being explored. Early projects introduced the concept of unique digital tokens on blockchain networks. One of the first examples was colored coins. These allowed people to attach unique information to small amounts of Bitcoin, creating the earliest version of digital assets. It was a simple idea, but a powerful one. 2017, the first breakthrough. The real turning point came in 2017. This is when NFTs began to take shape on Ethereum. One of the earliest and most influential projects was CryptoPunks, a collection of 10,000 unique digital characters, each with distinct traits: each verifiably owned. For the first time, people could collect digital items, prove ownership, and trade them freely. Soon after, another project captured global attention, CryptoKitties, a game where users could buy, breed, and trade digital cats. It became so popular that it temporarily slowed down the Ethereum network. That moment proved something important. People were willing to assign real value to digital assets. 2020 to 2021, the NFT explosion. For a few years, NFTs remained a niche interest. Then came 2020, and everything changed. The world was becoming more digital, and attention shifted rapidly toward online assets. In 2021, NFTs entered the mainstream. Major events included digital art selling for millions, celebrities entering the space, and global brands launching NFT projects. One landmark moment was the sale of a digital artwork by Beeple for over $60 million. That single event brought NFTs into global conversation. The rise of communities. Around the same time, projects like Bored Ape Yacht Club emerged. These were more than just digital images. They were memberships, communities, status symbols. Ownership gave access to exclusive groups, events, and opportunities. NFTs were no longer just assets. They became social and cultural identifiers. Institutional adoption. As the space matured, larger players began to take notice. Companies, investors, and institutions started exploring NFTs. Use cases expanded into gaming, music, fashion, real-world asset tokenization. This marked a shift from experimentation to real-world application. Market cycles and maturity. NFTs experienced volatility. Periods of rapid growth were followed by corrections. But these cycles served a purpose. They filtered out unsustainable projects, speculative hype, short-term thinking. And what remained was a stronger, more mature ecosystem. Where we are now. Today, NFTs are evolving beyond collectibles. They are being used for digital identity, ownership records, access control, and financial systems. The focus is shifting from hype to utility and long-term value. The history of NFTs is not a straight line. It's a progression of ideas. From experimentation to adoption to evolution. Each milestone has brought us closer to a world where digital ownership is normal. Web 2 versus Web 3, the mindset shift. To truly understand NFTs and their long-term potential, you need to understand a deeper shift happening beneath the surface. It's not just about technology, it's about mindset. The difference between Web 2 and Web 3. Understanding Web 2. Web 2 is the internet most people use today. It's interactive. It's social. It's convenient. Platforms allow you to share content, connect with others, build online presence. On the surface, it feels empowering. But behind the scenes, control is centralized. Large platforms own your data, your content, your digital presence. You can participate, but you don't truly own. The Web 2 trade-off. Web 2 operates on a simple exchange. You get free access, in return for giving up control. Your attention becomes the product. Your data becomes the asset. Your activity becomes monetized by someone else. This model has worked, but it has limits. Enter Web 3. Web 3 introduces a new model. Instead of platforms owning everything, ownership shifts to individual users. Through blockchain technology, you can now own your digital assets, control your identity, participate in decentralized systems. No central authority required. The mindset shift. The real change isn't just technical, it's philosophical. Web 2 mindset. I use platforms. I create content for networks. I rely on systems to manage my assets. Web 3 mindset. I own my assets. I control my digital identity. I participate in systems, not depend on them. This is a shift from user, owner. Why this matters. In Web 2, value flows to platforms. In Web 3, value can flow directly to creators, users, investors. This changes incentives. Instead of building on rented platforms, you build on systems you can actually benefit from. NFTs in this shift. NFTs are a key part of this new mindset. They allow you to own digital assets directly, prove that ownership, and transfer it without permission. This is something Web 2 never offered. In Web 2, you could create value, but you didn't fully capture it. In Web 3, ownership allows you to retain and grow that value. A new digital relationship. This shift changes how people interact with the internet. You're no longer just a user, a consumer, or a participant. You become an owner, a stakeholder, a decision maker. And with ownership comes responsibility. A balanced perspective. Web3 is powerful, but it's not without challenges. With control comes risk, accountability, and the need for understanding. There's no central support system to fall back on, which means education becomes essential. The shift from Web 2 to Web 3 is not just an upgrade, it's a transformation. Access ownership, control freedom, dependence participation. Those who adopt this mindset early position themselves ahead of the curve, not just as users of the internet, but as owners within it. Art NFTs. When most people first hear about NFTs, they think of one thing: digital art. And for good reason. Art was one of the first and most visible use cases that brought NFTs into the spotlight. What are art NFTs? Art NFTs are unique digital artworks that are tokenized on the blockchain. In simple terms, they allow artists to create digital pieces, sell them as original works, and prove ownership through blockchain technology. Just like a physical painting, an art NFT can be owned, collected, and resold. But unlike physical art, it exists entirely in the digital world. Ownership in digital art. Before NFTs, digital art faced a major challenge. It was easy to copy, easy to share, and almost impossible to assign true ownership. An artist could create something valuable, but struggle to monetize it properly. NFTs changed that. Now artists can attach their work to a verifiable certificate of ownership. This means the original piece is identifiable, ownership is trackable, and value can be established. Why art NFTs became popular? Art NFTs solve two key problems at the same time. For creators, artists gained direct access to buyers, global exposure, and control over their work. No galleries required. No intermediaries taking large commissions. For collectors, buyers gained verifiable ownership, digital scarcity, and the ability to resell assets. Art became both cultural expression and investable asset. Royalties, a game changer. One of the most powerful features of art NFTs is royalties. Artists can earn a percentage every time their work is resold. This is something traditional art rarely offers. Instead of earning once, creators can benefit from the long-term success of their work. Global marketplace. Art NFTs exist in a global, always active market. Anyone, anywhere can discover, purchase, and trade digital art. This removes traditional barriers like location, access to galleries, and industry connections. Challenges to consider. While art NFTs offer new opportunities, they also come with risks. Not all artwork holds long-term value. Some projects are driven by hype rather than substance, and prices can be highly volatile. This is why understanding value is essential. Factors like artist reputation, community support, and uniqueness all play a role. Beyond the image, it's important to understand the value of an art NFT is not just the image itself. It includes ownership history, scarcity, cultural relevance, and market demand. In many ways, it's similar to traditional art, but with digital advantages. Art NFTs were the first major step in proving that digital ownership has value. They empowered creators, opened new markets, and introduced millions of people to NFTs. But this is just one use case. Gaming. Assets. Gaming has always been one of the most active digital economies in the world. Millions of players spend time and money on skins, weapons, characters, virtual items. But here's the problem. In traditional gaming systems, you don't truly own any of it. The old model, controlled by the game. When you buy an in-game item, what are you actually buying? In most cases, you're purchasing access, not ownership. The game developer controls everything. They can remove items, change their value, or shut the game down entirely. Which means your digital assets can disappear overnight. The new model, NFT gaming assets. NFTs change this completely. In NFT-based games, your in-game items become assets you truly own. These can include characters, weapons, skins, land, or collectibles. And because they are NFTs, they exist on the blockchain, not just inside the game. This means the game no longer fully controls your assets. You do. What makes NFT gaming different? 1. True ownership. When you own a gaming NFT, it belongs to you. It's stored in your digital wallet, and no one can take it without your permission. 2. Transferability. You can sell your items, trade them, or transfer them to others outside the game environment. 3. Open market value. Your in-game assets can have real-world value. Players are no longer just spending money, they're participating in a digital economy. Play to earn and beyond. NFT gaming introduced a powerful concept: play to earn. Instead of just playing for entertainment, players can earn assets that hold value. Time spent in-game can translate into tradable items, sellable rewards, or long-term digital assets. This changes the role of the player. You're no longer just a user, you become a participant in the economy. Virtual worlds and digital land. Some NFT games go even further. They offer virtual land, digital environments, and player-owned ecosystems. These spaces can be developed, monetized, or resold. In these worlds, ownership extends beyond items to entire digital environments. Challenges to consider. As with any emerging space, there are risks. Not all games succeed. Some economies are unsustainable, and asset values can fluctuate significantly. This is why evaluation is critical. The strongest projects focus on gameplay quality, active communities, and long-term utility. NFT gaming transforms players into owners. It introduces real ownership, real economies, and real opportunities. But most importantly, it redefines what it means to play, from entertainment to participation to ownership. Music and media rights. The music and media industry has always been driven by creativity. But behind the scenes, it's also been shaped by control. Control over distribution, revenue, and ownership. For many creators, that control has never fully been theirs. The traditional model. In the traditional system, artists often rely on intermediaries. These include record labels, streaming platforms, publishers. While these systems provide exposure, they also take a significant share of the revenue. And in many cases, artists don't fully own their work. This creates a gap between creation and compensation. NFTs enter the music industry. NFTs introduce a new model, one where creators can own their content, monetize directly, and connect with their audience without intermediaries. Music and media can now be turned into NFTs. These NFTs can represent songs, albums, exclusive content, or rights to revenue. This transforms content into an ownable digital asset. How music NFTs work. Instead of uploading music to a platform and earning small royalties, artists can sell limited editions of their work, offer exclusive access to fans, or share ownership of future earnings. Fans are no longer just listeners, they can become supporters and stakeholders. Direct creator-to-audience connection. NFTs remove the distance between creators and their audience. This creates a more direct relationship. Artists can reward fans with early access, behind-the-scenes content, VIP experiences, or exclusive releases. Ownership becomes more than financial. It becomes personal and community-driven. New revenue opportunities. NFTs open multiple income streams for creators. Instead of relying solely on streaming revenue, artists can earn through initial NFT sales, secondary market royalties, exclusive drops, and experiences. This gives creators more control over how they monetize their work. Royalties built in. Just like art NFTs, music NFTs can include automatic royalties. Every time an NFT is resold, the original creator can earn a percentage. This creates ongoing income, not just one-time payments. Impact on the media industry. This model extends beyond music. It applies to film, photography, podcasts, digital content. Creators across industries can tokenize their work, maintain ownership, and build independent revenue streams. Media is no longer just consumed. It can be owned and invested in. Challenges to consider. While the opportunity is significant, there are still challenges. Adoption is still growing. Not all audiences understand NFTs, and value depends heavily on the creator's reputation, audience engagement, and perceived exclusivity. As with any asset, understanding the fundamentals is key. NFTs give creators something they've long needed: control. Control over ownership, distribution, and revenue. And for audiences, they offer a new way to engage. not just as consumers, but as participants in the creator's journey. Real estate and tokenization. Real estate has long been considered one of the most powerful ways to build wealth. It is tangible, valuable, and historically stable, but it also comes with limitations. The traditional real estate model, buying property, is not always simple. It often requires large amounts of capital, legal processes, intermediaries such as banks and agents. Transactions can take weeks or even months, and access is limited. Not everyone can participate easily. Introducing tokenization. Tokenization changes this. In simple terms, tokenization means converting ownership of a real-world asset into digital tokens on a blockchain. These tokens can represent full ownership or fractional ownership, and this is where NFTs come in. NFTs in real estate. NFTs can be used to represent ownership of unique assets, including property. For example, a single NFT could represent ownership of a house, a piece of land, or a commercial building. Alternatively, multiple tokens could represent shares in a property. Fractional ownership. One of the most powerful ideas in tokenization is fractional ownership. Instead of needing large capital to buy an entire property, investors can purchase a fraction of it. This means lower barriers to entry, more accessibility, and diversified investment opportunities. Real estate becomes more flexible. Faster and more efficient transactions. Blockchain technology simplifies the process of buying and selling. Transactions can become faster, more transparent, and less dependent on intermediaries. Ownership records are stored securely and can be verified instantly. Global access. Tokenization removes geographic limitations. Investors from around the world can participate in property markets without being physically present. This creates a more open and connected investment landscape. Liquidity, a major shift. Traditional real estate is considered illiquid. It takes time to sell, and access to buyers can be limited. With tokenization, ownership can be divided and traded more easily. This introduces a new level of liquidity to real estate markets. Challenges and considerations. While the potential is significant, this space is still evolving. Challenges include regulatory frameworks, legal recognition of tokenized ownership, market adoption. Not all tokenized assets are equal. Due diligence remains essential. Beyond real estate, tokenization is not limited to property. It can apply to stocks, commodities, intellectual property, and other real-world assets. This signals a broader shift in how ownership is structured. NFTs and tokenization are bridging two worlds, the physical and the digital. They are making traditionally exclusive assets more accessible, flexible, and efficient. And in doing so, they are reshaping how we think about ownership. Utility NFTs, access and memberships. So far, we've explored NFTs as art, assets, and investments. But there's another powerful category, one that shifts the focus from ownership alone to functionality. These are called utility NFTs. What are utility NFTs? Utility NFTs are digital assets that provide access, benefits, or real-world functionality. In simple terms, they don't just represent something you own, they give you something you can use. Think of them as digital keys. Access through ownership. When you own a utility NFT, you unlock specific privileges. These can include exclusive content, private communities, events and experiences, products or services. Ownership becomes more than symbolic, it becomes practical. Memberships on the blockchain. Utility NFTs are often used as membership passes. Instead of signing up with an email or subscription, your access is tied to your NFT. If you own the NFT, you are part of the group. If you sell it, the access transfers with it. Membership becomes transferable, verifiable, and controlled by the holder. Real-world examples of utility. Utility NFTs can unlock a wide range of benefits. For example, access to private investment communities, exclusive online platforms, premium educational content, or even event tickets, VIP experiences, brand perks, and rewards. In this model, the NFT is not the end product, it's the gateway. A shift in business models. Utility NFTs are changing how businesses interact with customers. Instead of one-time purchases, brands can build ongoing relationships. Customers become members, participants, and long-term supporters. This creates stronger engagement. Ownership meets access. In traditional systems, access is often controlled by central platforms. Accounts can be suspended, restricted, or removed. With utility NFTs, access is tied to ownership, not permission. As long as you hold the NFT, you hold the access. What determines value? The value of a utility NFT depends on its usefulness. Key factors include the quality of the benefits, the strength of the community, the credibility of the creators. Without real utility, value becomes difficult to sustain. The bigger opportunity. Utility NFTs represent a shift from static assets to functional assets. They combine ownership, access, and experience. This opens the door to new possibilities in business, education, entertainment, and beyond. Utility NFTs are not just about what you own, but what your ownership allows you to do. They transform NFTs from collectibles into tools. Minting, buying, and selling. By now you understand what NFTs are and why they matter. The next step is understanding how the market actually works. Because behind every NFT, there are 3 key actions: minting, buying, and selling. What is minting? Minting is where NFTs begin. In simple terms, minting is the process of creating an NFT on the blockchain. When an NFT is minted, a digital file is linked to the blockchain, ownership is recorded, and the asset becomes unique and verifiable. Think of it like this. Minting is similar to producing a limited edition item. Once it's created, it becomes part of a permanent digital record. Who can mint NFTs? Anyone can mint an NFT. This includes artists, creators, brands, and even developers. All you need is a digital asset, a compatible platform, and a digital wallet. But not all NFTs hold value. Value depends on quality, utility, and demand. Buying NFTs. Once NFTs are created, they enter the marketplace. Buying an NFT is similar to purchasing any asset, but with a digital process. Typically, buyers connect a digital wallet, choose an NFT, and complete the transaction using cryptocurrency. Once purchased, the NFT is transferred to your wallet, and the blockchain updates to show you as the new owner. What happens after you buy? When you own an NFT, you can hold it as a long-term asset, use it if it has utility, or resell it on the market. Ownership is fully in your control. Selling NFTs. Selling is where the market becomes active. NFT owners can list their assets for sale on marketplaces. There are 2 common methods. Fixed price. You set a price. A buyer can purchase instantly. Auction. Buyers place bids. The highest bid wins. Once the sale is complete, ownership transfers to the buyer, and funds are transferred to the seller. The role of marketplaces. NFT marketplaces act as platforms where NFTs are minted, bought, and sold. They provide visibility, liquidity, and access to buyers and sellers. But remember, the marketplace doesn't control your asset, the blockchain does. Transaction costs, gas fees. Most NFT transactions involve fees. These are often called gas fees. They cover the cost of processing transactions on the blockchain. Fees can vary depending on network activity, platform, and timing. Understanding costs is essential for managing profitability. Market dynamics. The NFT market operates on supply and demand. Prices are influenced by scarcity, popularity, utility, and community interest. This means prices can be highly volatile. Not every NFT will increase in value. 8. The bigger picture. Minting creates assets. Buying transfers ownership. Selling creates opportunity. Together, these actions form the foundation of the NFT economy. The NFT market is not complicated, but it requires understanding. When you know how assets are created, traded, and valued, you move from being a participant to being a strategic investor. Marketplaces explained. OpenSea, Blur, and more. Now that you understand how NFTs are minted, bought, and sold, the next question is, where does all of this happen? The answer is NFT marketplaces. What is an NFT marketplace? An NFT marketplace is a platform where users can discover NFTs, buy and sell assets, and interact with the digital economy. Think of it like a digital marketplace, but instead of physical goods, you're trading digital ownership. The role of marketplaces. Marketplaces act as the interface between users and the blockchain. They make it easy to browse collections, view prices, complete transactions without needing deep technical knowledge. But remember, the marketplace is just the platform. Your assets are still stored on the blockchain, not inside the marketplace itself. Popular NFT marketplaces. Let's look at some of the most well-known platforms. OpenSea. OpenSea is one of the largest and most widely used NFT marketplaces. It offers a wide variety of NFTs, user-friendly navigation, support for multiple categories. It's often the starting point for beginners. Blur. Blur is a newer marketplace designed for more advanced users. It focuses on speed, professional trading tools, and real-time data. It appeals more to active traders and investors. Other platforms. There are many other marketplaces, each with its own focus. Some specialize in art, gaming assets, or curated collections. Choosing the right platform depends on your goals. How marketplaces work. The process is straightforward. First, you connect your digital wallet. This allows the platform to display your NFTs, enable transactions, and confirm ownership. Then you can browse listings, filter by category or price, and select assets of interest. When you decide to buy, the transaction is processed through the blockchain. The marketplace simply facilitates the interaction. Fees and costs. Most marketplaces charge fees. These can include platform fees, transaction fees, and blockchain gas fees. It's important to understand these costs before making decisions. Small fees can add up over time. Market dynamics. Within platforms, different marketplaces can have different pricing trends, liquidity levels, and user activity. This means the same NFT might be priced differently depending on where it's listed. Understanding platform behavior can give you an edge. Safety and verification. Marketplaces also help users verify collections. This reduces the risk of fake NFTs, scams, or duplicate listings. However, responsibility still lies with the buyer. Always do your own research. Choosing the right marketplace, the best platform for you depends on your approach. If you're a beginner, look for simplicity and accessibility. If you're more experienced, look for speed, data, and trading tools. There is no single best marketplace, only the one that fits your strategy. NFT marketplaces are the gateway to the digital asset economy. They make it possible to discover opportunities, execute transactions, and participate in the market. But they are tools, not authorities. The real power lies in ownership on the blockchain. Gas fees, wallets, and transactions. To confidently navigate the NFT market, you need to understand three essential components: wallets, gas fees, and transactions. These are the tools and mechanics that power everything behind the scenes. Digital wallets, your gateway to ownership. A digital wallet is your personal access point to the blockchain. It's where you store your NFTs, hold cryptocurrency, and manage your transactions. But unlike a traditional wallet, it doesn't hold physical items. Instead, it stores access keys that prove ownership. Think of it like this: your wallet is your identity in the digital asset world. What makes wallets important? Your wallet gives you full control. That means only you can access your assets, only you can approve transactions, but it also means responsibility. If you lose access to your wallet, you lose access to your assets. There is no reset password system. Transactions, how value moves. Every action in the NFT world is a transaction. For example, buying an NFT, selling an NFT, transferring assets, minting new items. Each transaction is recorded on the blockchain. Once confirmed, it becomes permanent, transparent, verifiable, and secure. What are gas fees? Gas fees are the cost of processing transactions on a blockchain. Whenever you buy, sell, or mint an NFT, you pay a small fee to the network. This fee compensates the system for validating transactions, securing the network, and maintaining operations. Think of gas fees like a transaction cost, similar to paying a fee when sending money through a bank. Why gas fees change? Gas fees are not fixed. They vary depending on network activity, demand, and timing. When the network is busy, fees increase. When activity is lower, fees decrease. Timing your transactions can make a difference. Managing costs. Understanding gas fees is essential for profitability, especially when buying lower-priced NFTs, making frequent trades. Sometimes fees can significantly impact your returns. The full process, simplified. Let's bring it all together. When you interact with NFTs, you use your wallet to connect to a marketplace. You initiate a transaction, buy, sell, or mint. You pay a gas fee to process it. The blockchain records the result, and just like that, ownership is updated. Why this matters? These systems remove the need for intermediaries. You don't need a bank, a broker, or a central authority. You interact directly with the system. This is what makes NFTs powerful, but also what makes understanding the process essential. Wallets give you control. Transactions move value. Gas fees power the system. Together, they form the engine of the NFT economy. Master these fundamentals, and you move from confusion to confidence. Supply and demand dynamics. At the core of every market, there is one simple principle: supply and demand, and the NFT market is no different. Understanding this principle is essential because it directly influences price, value, and opportunity. What is supply and demand? Supply refers to how much of something exists. Demand refers to how many people want it. When demand is high and supply is limited, prices tend to rise. When supply is high and demand is low, prices tend to fall. Simple in theory, but powerful in practice. Supply in the NFT market. In NFTs, supply is often predefined. A creator can decide to release one unique NFT, 100 limited editions, or 10,000 items in a collection. This creates built-in scarcity. The smaller the supply, the more exclusive the asset can feel. Demand, the driving force. Demand is where value truly comes alive. People buy NFTs for different reasons: investment potential, community belonging, utility and access, cultural relevance. The stronger the demand, the more attention and value an NFT can attract. When supply meets demand, the most successful NFT projects find a balance. Limited supply, combined with strong demand. This is where prices can increase rapidly. But if demand fades, even scarce assets can lose value. What drives demand? Demand doesn't appear randomly. It is influenced by several key factors. Creator reputation. Well-known creators often attract more attention. Community strength. Active, engaged communities can drive sustained demand. Utility. NFTs with real use cases often hold stronger long-term interest. Market trends. Hype cycles and trends can temporarily increase demand. Understanding these drivers gives you an advantage. The role of hype. Not all demand is sustainable. Some projects experience rapid growth, driven by hype rather than fundamentals. Prices rise quickly, but can fall just as fast. This is where many investors make mistakes, confusing attention with long-term value. Market cycles. The NFT market moves in cycles, periods of high demand and rising prices, followed by corrections and consolidation. These cycles are normal. They help filter out weaker projects and strengthen the overall market. Reading the market. As an investor or participant, your goal is not just to follow the market, it's to understand it. Ask yourself, is demand organic or hype-driven? Is supply limited or excessive? Is value supported by utility or speculation? These questions separate short-term reactions from long-term strategy. Supply creates scarcity, demand creates value, but true opportunity lies in understanding both. Because in the NFT market, price is not random, it's a reflection of perception, interest, and belief.